Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different areas that go outside of just the S&P 500. First of all, we do look at earnings as they apply to the S&P 500. We look historically as well as forward. Then I go through and I do a pretty intense study of growth versus value. We want growth to outperform value when the market's positive. If value is outperforming growth, that's usually when the market is more defensive or actually going down. Then we look at other indexes, other sectors that are outside of the S&P and see, can we get any clues from those other areas to see what will ultimately happen in the S&P and what is happening right now. This is being prepared for Monday, December 30th. Before I get into that, there's a thing called the SPXInvesting Program. It's still free for a few more days till the end of 2024. If you feel that will help you out, please check the link here. It'll take you to the website. There's also a link to a video below this video that tells you more about the program. And if you have any questions, you're more than welcome to email me. Also, this is just one of the weekly videos that I do, the intermarket analysis video. All the weekly videos that I prepare are meant to tie into the daily video, and that's where you get most of your insight from. Let's look at S&P 500 valuation first on a historical basis. And what we're seeing now is what we've been seeing for actually the last number of years, is that the S&P is overvalued when you look historically at earnings. You compare the current price with what earnings were at that time, and you come up with some different levels called a PE ratio, and we're well above the red dashed line here, and we have been for a long time. That just means on a historical basis, the market is expensive. To give it a little bit more clarity, I break it out down below where I measure the difference between the current price of the S&P and the PE ratio of 20, and we're getting to a very high level. And I'm hearing this more in things that I run across, that there are concerns about valuation. But this has gone on for a while, and it kind of comes and goes as far as what a topic is to be concerned about. But the market really doesn't pay attention to this all that much. And I don't use this kind of analysis really to make decisions, because we can be in this situation for a long time. The market can still go up, it can still go down. But other folks who base their investments around valuation may find this very important in making their overall decisions. But if you had gone according to this and got out when the S&P started to get expensive, you would have lost a lot of gains that we've been experiencing. This also matches up historical earnings with different events that have happened going back to 1980 and what the valuations were at that time. Another take on historical earnings is a thing called the Shiller PE ratio. This is also quite expensive right now. We're coming in at 37.94. Just to give it a little bit more context, you can see this going back, excuse me, this going back all the way into the 1800s. Then the median and the mean is the same as what we've seen now for the last number of years, between 16 and 17. So even with the pullback that we saw in Friday's session, we ended up having a positive week, but there have been times when stocks have gone down, and this is still overvalued from that particular perspective. Now, the market looks forward, and the market uses forward PE ratios. And on this chart put out by Edward Yardeni is looking at the different main indexes and what are their valuations based on projections and forecasts of earnings. This purple line is the mega cap 8. Some others call them the Magnificent 7, just the mega caps, the really big companies that really drive the market. And they're coming in at 30.9. So we still use that 10, 15, 20 scale, and this is coming in at 30. So yeah, they're considered to be expensive, even looking forward. But that doesn't seem to stop these stocks when they're really going up. And it can have more of an impact when they're going down. And when the market isn't really doing all that much, that's when we hear more about valuation concerns. But the market's going to do what it's going to do. So again, we use this more for just informational purposes. And when we look at the forward PE of the S&P 500, which is the red line, we're still above that 20 level. We've dropped a little bit, but we're coming in at 21.9. So even looking forward, we're still expensive. We look backward, we're looking expensive. But I use other charts and part of technical analysis to really evaluate, okay, are we looking to go up or down from here? Again, this is more for information. Now, we're in a period of time when the small caps and the mid caps should be doing quite well, but they really haven't taken off all that much lately. They've actually been declining, and they're more around the fairly priced level when it comes to PE ratios. The mid caps are at 15.9, the small caps are at 15.7. And so this is more fairly priced. And folks will try to go into small caps and mid caps, find a good solid company, and then compare that PE ratio to this PE ratio, and sometimes find that it's an investment that is attractive to them. Then we look at another area of growth versus value. First of all, I just look at growth all by itself. In an uptrend, the blue line's above the red line. We have been pulling back, but we're still right around the 50-day moving average. We're seeing a little bit of weakness here with the value index, even though it's still in a longer term uptrend. It has come down below its 50-day moving average. And so this is not as strong as it had been, but still in a longer term uptrend. Where we get some insight is by doing ratios between the two. I just take growth and divide it by value. That's what you see on top. And this is showing how growth is outperforming, even though it pulled back over the last couple of sessions. But we're looking at the bigger picture here with the upward trend. And when this is going up, that's more positive for the market. And then just to get a little different perspective, we look at a value versus growth ratio down below, showing how value is underperforming growth. Look at a couple of ETFs where we're seeing growth outperforming value when this ratio is going up. When this ratio is going down, that means value is underperforming growth. Then we look at a longer term chart here showing how growth is outperforming value, and here where value is underperforming growth. So we're seeing confirmation as we look at these charts, and then we look at another growth versus value ratio showing how growth is outperforming. We look at a couple of ETFs, a growth ETF and a value ETF, also showing how growth is outperforming, and then how value is underperforming. Then we break it out based on the indexes. Small caps been pulling back a little bit lately, but small cap growth to value has been pretty strong, strong enough to generate a recent golden cross here. So this could be underlying strength in the small caps. We're just not seeing it reflected in price. Where you can see the index up here has really been trailing off, really declining. And at best, we've just been going sideways now. When this is the time of year when small caps usually perform well, it's just not happening, at least yet. And we're seeing pretty much that same thing with the mid caps. The growth to value ratio is pretty strong, but the index itself has been coming down and going sideways. S&P growth to value. This is the one that I focus on the most. Still in a longer term uptrend, some recent weakness though. But if this can continue to go up and outperform, showing that growth is outperforming value, that's more positive for the S&P. We want to keep an eye on inflation. This first chart is a long-term chart. It's a monthly chart of the CRB index, which are commodities. And then down below is a ratio between inflation and deflation. And this continues to trail off. And these are monthly charts, so this is pretty long term. But you can see we're going down and the red line's going down too as inflation has been going down additionally. Then here's a daily chart of the CRB index, which is still in a downtrend. It's been chopping around a little bit. It seems like it has a good day, it's in an uptrend. If it has a bad day, it's in a downtrend. And it's just been chopping right now and not really showing any inflationary problems at this time, but that could always change. And then another one that we look at for inflation is the Baltic Dry Index. For the most part, this is continuing to go down, which is not necessarily inflationary. And then what does the market think as far as inflation expectations? They are going up a little bit. Now, the stock market has been under some pressure lately, and especially in Friday's session. We have the 10-year yield and interest rates together going back up, and that's causing some concerns even with the Fed coming in and cutting rates. So it's like, wait a minute, that doesn't make sense. The Fed's making rates lower and the market's making rates higher. Well, the Fed comes in and they cut short-term rates. The rates that we're looking at, usually I focus on the 10-year. That's further out. That's longer term rate. And when that starts to go up, that means that the market is more concerned about inflation. Now, even though we're not seeing it in our charts as far as inflation, we're seeing a little bit of a pickup here. But the other charts that we look at don't really show that inflation is a problem. But the market's still becoming concerned about that. And so interest rates are going back up. That's been really holding stocks from going higher. And we would be more positive if we could get to the point where interest rates start to come down, and then that would help stocks go up. And it would also help those small caps and the mid caps to perform better. But it just hasn't all come together at this point. Some other markets that we just look at for informational purposes, aluminum, which is in an uptrend, even though it came back to its 200-day moving average. Corn is starting to start an uptrend here after it had been really declining in a downtrend. Wheat is still in a downtrend. We keep an eye on fertilizer because if all these areas that we're looking at right now, if they really start going up, that could end up being inflationary. Oil, watching this for inflation purposes as well as geopolitical reasons, but we've been just chopping around the 70 level, not really moving all that much. So it hasn't been that big of a concern, but that could always change too. We look at a gold to oil ratio. When this is going up, that means gold's outperforming. Well, oil's been chopping sideways. Gold has been pulling back a bit, so we've been going sideways with this ratio recently. We look at a correlation between oil, which is the red dashed line, and that's been going up here, but it's kind of just not done all that much. And then we look at the 10-year yield here, um, which is starting to go back up as well. And we look at the correlation between the two, and it's coming back more to neutral. And it's interest rates are going up, but oil's just been going sideways. And that's why we're not seeing a really strong relationship right now. Gas, that's still in a downtrend. We look at diesel, also kind of chopping sideways after it had been declining. Heating oil, which is in a downtrend. Natural gas, which is now switched over to an uptrend. And then we keep an eye on copper, which is in a downtrend. And we look at this more like a barometer for the economy. If the market, the copper market, is anticipating a stronger economy, copper goes up. A weaker economy, copper goes down. And the market's a little bit confused right now. Depending on what you look at and what your view is, you might think the economy is doing quite well. But if you look at the reality of the economy, a lot of people are really suffering. And there are some concerns about inflation. There are some concerns that the economic reports that we've been getting, they may be revised and show that we weren't growing all that well after all. And the market's not really picking that up, but copper kind of is, as it's been dropping down here, and it's not seeing an awful lot of economic strength. We look at a copper to gold ratio, which continues to decline. That just means copper is underperforming gold. And this is a longer term chart of that same relationship. And then to give it a little bit more context, as this has been going down, we're seeing the 10-year yield and the 2-year yield continue to go up, even though all of these are on different scales. They've become, for the last couple of years now, far apart from each other, where they tend to move in the same general direction and they tend to not get all that far apart. And they've been far apart and they're going in opposite directions now. So we're seeing this gradual shift to a change in the overall economic climate of things. But this has been going on now for quite a while, and so we're just kind of keeping an eye on this for right now. We look at gold, which is still in an uptrend, but underneath its 50-day moving average. And silver's coming back down and actually falling a little bit below its 200-day moving average, but still in a longer term uptrend. The closing price for gold on top, the closing price for silver in the middle area, and then the correlation between the two, which is pretty strong right now. When you get a high reading in this correlation chart, that means they're going in the same direction at the same time. We look at a gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we plot it against the dollar because there's an interplay between precious metals and currencies. And there's a pretty strong correlation between the two right now, which is usually what you would expect. Here's a chart just of the dollar index, which is in a pretty solid uptrend. We got up into the 108 range there during this past week. We've since come down into the 107, the high 107s, but this could also be pressuring stocks. Stocks like a weaker dollar for conversion purposes and import-export reasons. And so this is kind of helping stocks not perform as good as they had been. Then we compare the US dollar index with other currencies, where the euro's in a downtrend compared to the dollar. And this top chart and the bottom chart are pretty much mirror images of each other. If one's going up, the other one's going down. Then we also plot the Japanese yen here, which is in a downtrend to the dollar. Then I break them out. This is the euro to the dollar, which is now in a downtrend here. We also see the Japanese yen is in a downtrend to the dollar, and the British pound has just seen a recent crossover to a downtrend when compared to the dollar. Then we look at different indexes, and I do show this in the daily video. The little bit of concerning thing that we're seeing here is that we have the weighted version of the S&P 500. That's the regular index that you hear all about. And that's been holding up a little bit better, even though we've been kind of chopping sideways and even had some down days. But the red line's been going down faster, and that's a bit of a concern. That means when you treat all stocks the same in the S&P, the red line is underperforming the index itself. Now, to change that around and say it a different way, that means the mega caps and the large caps are holding up better right now. And we like that because when they perform better, the S&P goes up, and we can do things when that happens. And we would like this red line to come back up and get closer to the bar chart. But if it doesn't, then that's when we keep a closer eye on the mega cap stocks, because if they're doing well, then the S&P will do well. This is a ratio between the two. When this is going down, that means the equal weight is underperforming the S&P, and that's what we've been seeing lately. We look at stocks versus commodities, and we still continue to see and have for quite some time now how stocks are outperforming. Here's an inverse showing how commodities continue to underperform stocks. We look at the NASDAQ 100, which had a really good year, and the S&P 500, which also has had a really good year. But we topped out in the summer with the NASDAQ 100 outperforming, and then we pulled back, and through the fall and into late fall, the NASDAQ 100 was underperforming the S&P. As we saw other stocks in the S&P starting to perform better, the mega caps were kind of lagging behind. We're seeing a little bit of a shift with that right now. That's why we're focused more on the mega caps and the tech sector and semiconductors and things like that, because those are the mega caps and those are in the NASDAQ 100. And we're starting to see a golden cross here, which means that the NASDAQ 100 is outperforming. And that's usually more positive for the market, even though it's been pulling back over the last few sessions. If this could continue to go up, that'll be more positive because the stocks that are in the NASDAQ 100 are also in the S&P 500. And then the big stocks in the S&P 500, which means the S&P 100, they continue to outperform the smaller stocks. The Nasdaq is outperforming the S&P 500, and that's tech, and that's more positive for the market, and it brings the S&P 500 along with it. Then this is kind of interesting though. The Nasdaq 100, which is outperforming the S&P, the Nasdaq 100 is not outperforming the Nasdaq itself, and that means there's more broad participation that the Nasdaq is actually doing better than the Nasdaq 100. And that's what we see when this ratio is going down. And we look at the mega caps, the real big stocks, compare it with the equal weight version of the S&P, and this has really been going up. And that's why we're focused on the mega caps, because they're the ones outperforming currently. Small caps, which continue to underperform the S&P. As I've said before, this is supposed to be a real positive time for small caps, but as long as interest rates keep going up, small caps are really going to struggle. And that's what we've been seeing right here. And another ratio, the red line are small caps to S&P, and that continues to go down. And then just to give it some context, the blue line is the S&P 500. It's been going up as this ratio has been going down. Mega cap, when you look at them by themselves, even though pulled back a little bit here, still in a really solid uptrend, well above its 50-day moving average. The 50 is above the 200 and prices above both, and they're all going up right now. So that's still looking pretty solid there. The robotics and AI ETF, not really doing all that good. It's been chopping sideways. It's still at the higher end of the rainbow, but it's not really trending all that much. What's a little more concerning is when we compare the robotics and AI ETF with the tech sector, and it's underperforming here. It's actually been going down. And AI is all the craze, and AI stocks are supposed to be where it's at. Well, when you compare the AI stocks with the tech sector, they're not doing all that well. The Dow Jones Composite, which is the Dow, the transports, and the utilities taken together, still in an uptrend, but coming under some weakness. Now, just a few weeks back, the Dow set an all-time high, but since then has been pulling back. The transports have just been chopping sideways. They did set a recent all-time high, but they're not really showing any strength right now. The utilities were really strong for a lot of 2024, but lately have been pulling back. So they put all three of those together, and we're dropping underneath the 50-day moving average, but we're still in a longer-term uptrend. The Wilshire 5000, which is a broad market measure. This is critical after Friday's session. We're still above the 50-day moving average, and we're seeing that in some other indexes like the S&P, where we fell in Friday's session. We dropped below the 20-period moving average. That's turned the short-term trend to negative, but we're still slightly above the 50-day moving average on the S&P. We're also still slightly above that 50-day moving average here with the Wilshire 5000. This is an area that we'll be watching. If we see more weakness and we drop below the 50-day moving average, that's going to turn things more negative. Another really big way of looking at the stock market is the total US stock ETF coming back and just slightly below its 50-day moving average. And low volatility stocks, when you look at them by themselves, they've been pulling back lately, but they have been in an uptrend. These are the stocks that folks get into when the market is under pressure and when the market starts to go down. So you look at them all by themselves, they're doing okay, but when you compare them to the S&P, they are really underperforming. We were underperforming, and then we started to see a bit of a shift over the summer months, and now this ratio is starting to go back down. Then we look at the advanced decline line, and this is kind of showing some weakness right now. We're below the moving averages with the NYSE common stock, S&P, mid caps, and small caps. We were trying to recover here, but until we can get back above the moving averages, this is a concern to us. We look at traditional Dow theory. Now, traditional Dow theory just uses the Dow and the transports, and we compare them with each other, where we had the transport setting a recent all-time high, and then shortly after that, we saw the Dow setting an all-time high. So that's a confirmation. And then we had utilities setting a high here. So that's also another confirmation. I include utilities in Dow theory, where a traditional Dow theorist just looks at the Dow and the transports. And here are the transports, which had been doing quite well, but since then have been pulling back, kind of going back down into the range that they've been in for most of 2024. We do a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming. And then we look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And we look at the correlation between the S&P and the Dow transports, and they're pretty strong. When they're up in this red area, they're tending to go in the same direction at the same time. You can see the transports were really going down as the S&P was going sideways, and that correlation really broke down there for a while. Now it's coming back and is a little bit more normal. Then a new variation of Dow theory could be, instead of using the Dow, use the S&P. Instead of using the transports, use the NASDAQ. Not setting all-time highs here. We're just seeing more of the confirmation of the recent weakness that's been playing out. Then breaking it down a little bit further, using the equal weight version of the S&P and comparing it to the equal weight version of the NASDAQ 100. They're really confirming each other right now. The FANG index has been one of the stronger areas of the market. This is also the mega caps, the Facebook, Apple, Amazon, Netflix, Google, Nvidia. This has been holding up well and is still above its 50-day moving average. But we hit this short-term trend line here. We were starting to break above it. Now we're breaking down back below it. We'll see if this ends up being something. We're also hitting a trend line resistance level with the S&P 500 that it's been having a real hard time breaking above that too. So keeping this in mind and then the S&P 500 overhead resistance in line, we'll just watch to see how that plays out there. ARC is was down in Friday session, but it is in an uptrend here on the daily chart. And then all world stocks and taking out US stocks really underperforming underneath its 200-day moving average, but still in an uptrend. But the longer we stay below both of these lines, the more we might see a death cross with this. Then when we throw US stocks into the equation, we see this ratio really going up. And this just means that US stocks continue to really outperform world stocks. Then we look at small caps and compare it to the tech sector, still not really doing all that well. It's in an uptrend. The blue line's above the red line. It's a little hard to see that, but we've really been pulling back. A lot of folks have really anticipated that small caps should do well, and they just haven't done that yet. The tech sector is still one of the stronger areas of the market. And we look at the S&P 500 on a monthly basis and then do a ratio with the EFA, which are stocks in Europe, Australia, Asia, and the Far East. And US stocks continue to outperform longer term. And we also see that the momentum shows that US stocks are outperforming. Keeping an eye on bonds, where we're going down with bonds based on price, which means we're going up with bonds based on yield. And that's not what the market likes right now. It wants to see this price going up and interest rates going down. Total bond ETF coming down and touching its 200-day moving average and in danger of a death cross here, but hasn't happened yet. If we could bounce up off of that, that would turn this ETF more positive. And these are bonds based on price. World Bond Index in a downtrend though. So US bonds are holding up a little bit better, even though they've been going down. The World Bond Index has actually started to this is the second week now that we're seeing a downtrend. But longer term, when you compare stocks to bonds on a monthly basis, stocks are still outperforming. This is a daily chart showing how bonds are underperforming. So we're seeing this on daily charts, weekly charts, and the weekly video. And then here with the monthly chart, stocks continue to outperform bonds on all time frames. High yield bonds, these are junk bonds, tends to follow closely what's happening in the stock market, and we've been seeing some weakness trying to come back up to its 50-day moving average. These are more conservative bonds, investment grade bonds, also coming down to its 200-day moving average. And we do a ratio between junk bonds and more conservative bonds, and junk bonds continue to outperform. Folks are willing to take on more risk to get a higher yield. We look at a stock to bond correlation, fairly strong between the two. So the price of stocks and the price of bonds have been going in the same basic direction now. That's when we get a high reading with this correlation chart. We look at corporate bonds coming all the way down to their 200-day moving average. And you're seeing a lot of 200-day moving averages, 50-day moving averages coming into the equation. So if bonds are going to make a stand on price, they're coming down to pretty critical support. And if we see a lot of these support levels converging, that may help bonds start to go up in price, which means down in interest rates. And if interest rates are going down, that could start to help stocks. But if we don't see that, then we might see a continuation of what's been happening lately. This is just a 10-year yield study with some Fibonacci retracement levels on here, and we're not really close to any lines. I still show these charts every week just to take a look at this. And then this is a long-term look at the 10-year Treasury yield where we are going back into a higher range. And then we look at a ratio between the price of stocks, the S&P 500 and the 10-year yield. This has been coming down lately as the S&P has been under pressure as interest rates have been going up. There's another Fibonacci retracement study with the 30-year yield, just to show for information right now. Junk bonds doing about the same as the overall market, coming back up to its 50-day moving average. And then we look at junk bonds versus government bonds. When this is going up, folks are preferring junk bonds. They're willing to take on that risk, and they're outperforming when compared to government bonds. Here's a chart, a daily chart of the yields, where Throughout the spring and summer, interest rates were going down. That was really helping stocks to go up. Then in September, that's when the Fed came in and cut rates, and the bond market since then has been more worried about inflation. And so yields are starting to go back up. You notice this kind of gray line here, that continues to go down. And that's been uninverting certain parts of the yield curve that we follow. That's been going down as other rates have been going back up. Then we went through a period of time in late November into December when stocks were doing well, interest rates were going down. Now interest rates have been going back up, and that's been pressuring stocks. If we could see a period of time when interest rates start to come back down, as I've been saying over and over, that would probably help stocks quite a bit. There's a weekly chart internationally. And as I pointed out in the weekly video, we want to keep an eye on this red line here. These are Japanese yields. And last summer, we had a problem on August 5th where the the problem ended up developing in Japan and then bled over into all the world markets. And it's like everybody thought the end of the world was coming, lasted a couple of days, and then everything was fine. But with this rate going back up, that could also bring what we saw last summer back into play at some point. It's the carry trade where folks can borrow yen for virtually zero interest, and then they use that yen and go out and do other investments. And it's basically a interest-free loan. Well, if interest rates start to go back up, that's going to change that whole equation and could start to cause some problems. And you notice here when interest rates were going up, it's about where we're at right now. This is back in over the summertime. And if this continues to go up, that could cause a problem, and we could see something similar to what we saw last summer. So we're keeping an eye on that. And then in the meantime, though, we're seeing US, UK rates and German rates continue to go up. And we look at the volatility of bonds, that's the move index on top, and the volatility of stocks, which is the VIX, and they're pretty much neutral. Now, when we look at the correlation between the two, do some ratios here. When this is going down, that means that bonds based on price are underperforming stocks. And that's what we're still continuing to see as bond prices have been going down and stocks have been holding up better and still in a longer term uptrend. We look at the S&P 500 and then look at 1 to 3 year bonds. This shows how stocks are outperforming, but we've been seeing some weakness and we're coming back into the top end of the rainbow. We look at a broad market measure, seeing pretty much the same thing. The S&P 1500 with 1 to 3 year bonds coming back down into the top end of the rainbow. It had fallen down a little bit more when we had that big down day. Since then, we've been bouncing back up. And we look at another broad market measure and look at 3 to 7 year bonds coming back down into the top end of the rainbow, but still looking pretty solid longer term. The tech sector to 3 to 7 year bonds, this is actually holding up a little better. We're still above the rainbow here. And then we look at the price of the 30-year bond, which is now resuming a downtrend here. But when you compare it to commodities on a ratio basis, the long-term price of bonds are still outperforming. Then we look at different sectors, and I just go through them alphabetically according to their symbol. So the first one that comes up is XLB, materials, which are in an uptrend but under a lot of weakness as the economy, they're anticipating some potential economic weakness, and we're seeing that being brought out here in the price of the materials sector. But when you compare it to the S&P, the materials are underperforming. Communication, a growth area. We want this to do really well, pulling back recently, but still above its 50-day moving average, and really performing well when we compare it to the S&P, even though this ratio had been coming down. Longer term, we're in an uptrend, and that's more positive for the market. Energy, which is in an uptrend, but really, really coming down here, falling below both its 50 and 200-day moving average, so it's really showing some recent weakness. And when you compare it to the S&P, it's really underperforming. Now, if there were inflation concerns coming into the market, you would expect energy to be doing better than it is. So we'll be watching this. If this really starts to go back up and improve, that means that there could be a flow of more inflation worries coming into the market. Then we look at financials. We want financials to do well, and they are. I was getting a little bit concerned as we were hitting the highs here in the latter part of November and then starting to pull back. and actually fell under the 50-day moving average. Now we're coming back up to the 50-day moving average and still in a longer term uptrend. So this chart's still looking, switching back and looking more positive. It's also looking good when we compare it to the S&P. Coming back with the ratio, but we're still in a longer term uptrend. Industrial's another economic sensitive area coming down below its 50-day moving average and starting to underperform when we compare it to the S&P after it had been performing better. We're still in an uptrend, but it's getting a lot weaker here. The longer we stay below both of these lines, the more we might see a death cross. Tech sector. This is the darling. This is what we want to do really well when we're positive on the market. Still in an uptrend and still looking pretty solid. And the tech sector's been doing well and the S&P's been doing well, so we're kind of seeing this ratio going sideways right now, even though it is in a downtrend. Now, earlier on in 2024, the tech sector was outperforming, and then it started to lag. What would help the market even more is if this ratio continues to go up, we see a golden cross. That means the tech sector is outperforming again, and that's typically stronger for stocks. If this starts to go down, that's going to put some pressure on the S&P, and it probably won't perform as well. Staples coming back down to their 200-day moving average, still in an uptrend. This is more defensive. And when this is weaker, we kind of like that because folks tend to get into this when they're more defensive on the market. But when you look at it all by itself, it's still in an uptrend, but it's underperforming when we compare it to the S&P. That just means that the more growth areas of the S&P are outperforming. Real estate doesn't like when interest rates are going up, coming all the way back down to its 200-day moving average. It's still in an uptrend. The blue line's above the red line, but not showing some recent strength here, and underperforming and seeing a death cross when we compare it to the S&P. Utilities really strong earlier on, falling back, still below their 50-day moving average. Still in an uptrend when compared to the S&P, but seeing some weakness with this ratio. Healthcare, another defensive area, seeing a death cross here when we look at the sector all by itself, and really underperforming when we compare it to the S&P. Then we look at a S&P to utilities ratio, kind of chopping around, but when this is going up, that means the S&P is outperforming utilities. And discretionary, this is another growth area, and we want this to be doing well. And it's been the best performing area going back to August when we had the end of the world day there. And then we've been really bouncing up since that time, and this has been the strongest performing sector. And doing good when we do the ratio between discretionary and the S&P. We want this to do well. And this includes things like Tesla, Amazon. Those companies are doing well and they're mega caps, then this ratio is doing well and the S&P is doing well. Semiconductors. Now, I have a number of different charts to look at here, and some of them are negative and some are positive. And I've really been honing in on this in the daily videos. When you look at the SOX index by itself, it's in a downtrend, and we're having a difficult time getting above these moving averages. It's acting as overhead resistance. This chart is not all that positive, even though it's been chopping sideways. This is also something that's not real positive, but it's been holding up. This is a ratio between the semiconductors and the tech sector. We want this to go up the way it was earlier in 2024. That's when the market really has some strength. Well, we hit the summer months and then we've been coming down here. And now is this a base or is this just a plateau before we get ready to go lower here? That's why I'm really watching this heavily. But then when you look at the SMH semiconductor ETF, we're still holding out above the 200-day moving average, where we're below the 200-day moving average with the SOX index, and we're still in an uptrend here, but we're in a downtrend with the SOX index. So we're seeing some contradiction there. We're holding out right now at about the 50-day moving average, and then longer term, this is a rainbow where we've been just chopping sideways. We're at a little bit above the rainbow right now, but we want this to really do better than it has been. And if it really starts to break down, that's going to really pressure the market. We'll look at energy to tech, showing how energy is outperforming. Excuse me, energy is underperforming tech, and tech is outperforming. We look at growth stocks, which are still outperforming bonds. So that just means the growth is looking much better now. And then we look at the tech sector to the 10-year yield, pulling back a little bit now, but still in a longer term uptrend showing tech is outperforming. There's an inverse showing how the 10-year yield is underperforming, even though This has been bouncing back up lately. We'll keep an eye on this. If interest rates continue to go up, that's probably going to pressure the tech sector, and we could see a golden cross here, which would be more negative for the market. Discretionary to staples. This has been more encouraging. We're seeing how discretionary is outperforming. For much of 2024, it's just been blah, 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 just going sideways. Now it's really starting to do better, and that's more positive for the market. And staples are underperforming discretionary, and that's also more positive for the market. Gold to the S&P, it's in an uptrend here, but just been chopping sideways. Gold's been doing quite well. The S&P's been doing quite well, so we're not really seeing much of a difference with this ratio. And when this is going up, that means gold's outperforming the dollar. Well, this has been coming back down as gold has been going down and the dollar continues to go up. This is another thing that I watch as kind of a barometer of the economy. These are high leverage loans. When you look at this ETF, we're still doing really well here. We're not even back down to the 50-day moving average. But I ran across this. This is put out by the Financial Times that is a Moody's chart. And this just says leverage loan defaults climb to 4-year high. And you look at these charts and we're seeing more defaults. It's not being reflected here in this ETF, at least at this time, but this chart is a bit of a concern. So we're going to be keeping an eye on this chart. And if it starts to really break down and show some weakness, that's going to cause more concern. But for right now, it's still holding up. The NYSE composite had been doing quite well in an uptrend, still is in an uptrend, but has fallen below its 50-day moving average. All stocks coming back up to its 50-day moving average. These are US and international stocks. Emerging markets coming down to their 200-day moving average, but still in an uptrend. And the Nikkei, which is the Japanese index, coming back and actually breaking a little bit above this red line. Bitcoin, which, all the craze was, let's get over 100,000, over 100,000. And it did it, and everybody partied, and they've been kind of selling ever since then, coming back down to its 50-day moving average. Those small caps, or real small stocks, micro caps, coming back down to their 50-day moving average, so still holding up. And then we look at the S&P on top, the home builders ETF, and we see there's a pretty strong correlation between the top chart and the middle chart. And that's okay. They might both be going down, but they're probably both going up at the same time. So we're not really seeing a divergence here. And internationally, this is a long-term oscillator. Still going up, but showing a little bit of weakness in China, rolling over a bit with emerging markets, going into a downtrend in Europe. Japan's starting to go into a downtrend, and the US is looking a little more vulnerable now too. So this is a little bit of a concern. This is a KST, and it takes a long time for this to shift. So this is a longer term trend oscillator. Then we look at the intermarket analysis chart. Right now, anyway, stocks are slightly outperforming bonds year to date. Then we have the dollar, which is in green, oil, which is red, and bonds based on price. So it looks like they're going to be negative on the year. Then we look at some correlations between the S&P and the dollar, and they're actually having a tendency to go in opposite directions right now. And then S&P to oil. Oil really hasn't been moving all that much, and we're seeing a fairly strong correlation. As the S&P has been going up lately, oil's been going up as well. And then the S&P to the 10-year yield, slight tendency to go in opposite directions. That's why we watch interest rates. And the tech sector to the 10-year yield, that's actually coming back more into a neutral reading right now. And then the S&P to the 2-year yield, also a pretty strong tendency to go in opposite directions. And then longer term, this is a monthly chart of the NYSE, still coming down now, but in well above this moving average, and the moving average is going up. And the Copic curve is still going up as well, another momentum oscillator. But then in the shorter term, this is a daily chart. We're seeing this NYSE record high percent index starting to come down. If this continues to fall, that's going to be more negative. And then a monthly chart of the S&P looking pretty solid above its moving average, and seeing a little bit of vulnerability here, but the PPO, or the percentage price oscillator, continues to go up. And then we look at the S&P, and then a ratio on the bottom, stocks to commodities again, but this is longer term, showing how stocks continue to outperform. And then another look at US versus global stocks. US stocks are outperforming and we're starting to go back up with the KST. Then at the very end, I look at the positive things and the negative things, and we have still a pretty long list of positive things. And my definition of positive is when the 50-day moving average is above the 200-day. So we look at growth and value by themselves. They are positive. The dollar is positive. Gold and silver are positive. The mega caps, the FANG index, ARK is still positive. The low volatility ETF by itself, but when you compare it to the S&P, really underperforming. Staples, the Dow Jones Composite Average, bonds based on price, except for the World Bond Index. And this is vulnerable right now. If we see more weakness in bonds, this is going to start to change. The tech sector, high leverage loans, the Dow, the NYSE Composite and Wilshire, those are broad market measures. The NASDAQ 100, mid caps, small caps, and micro caps. Even though they've been frustrating, especially the small caps for a lot of folks, they're still in uptrends. All stocks, emerging markets, and Bitcoin. Then, when the 50-day moving average is below the 200-day moving average, that's when we're negative. And we have the CRB index, copper, and then the euro, yen, and British pound when compared to the dollar, which is not necessarily helpful for the stock market, but it could be helpful if you want to go on a trip. You get a pretty favorable exchange rate. And then the SOX index, when you look at it by itself, but not when you look at the ETF. We have some positive charts and some negative charts at the same time. And then the World Bond Index is still under pressure. Thank you. Have a really good weekend, and I will talk to you in the next video.